Brilliant. Well, thank you very much, Mr. Watson, for inviting us. For the Bank of England to come and talk to schools is actually really important. If we could get you interested in economics, interested in the financial system, interested in the Bank of England, and understanding what we're there to do, we've done a very good thing, and it's a big strategic priority of ours, which is why I'm here today. I'm going to try and do 5 things in my 30 minutes. We'll see kind of if I manage to trot through it quickly enough. I'm going to run through what the Bank of England does. I'm going to then do a little bit of a deep dive on monetary policy. I know you guys were interested in the economic impact of what Trump's up to with his trade policy and Brexit, so we'll try and do a little bit on that. I wanted as well briefly to cover climate change. You might think, what has the Bank of England got to do with climate change? I'm the executive director responsible for that, so I'll talk you through the work that we're doing there. And then I want to leave with you with some ideas as to how you can interact with the Bank of England in the future. So kind of let's see if we can get through that in half an hour. What I thought I'd start with just a little bit about my journey and how I got to being here at the Bank of England. I grew up in Stockport, or in suburban Stockport. Stockport's a town that's south of Manchester, so in many ways a bit like Croydon is south of London. I went to the local comprehensive school there, did well at my A-levels, enjoyed economics a lot, and so decided to study that at university. Having studied economics, I took a year out, and I decided I wanted to apply that in the public sector, because what appealed to me was not making money, but interesting intellectual challenges and doing the right thing. So I applied to the Bank of England after my year out, and 20-something years later, which is probably longer than even your teachers have been alive, never mind you lot, I'm still there. I've worked in a huge variety of different roles in my time at the bank, and I'll give you 3 highlights just to give you a sense of the variety and how interesting and important our work is. One of the jobs I really enjoyed was when I was private secretary, which is Bank of England and civil service speak for person who stands at the right hand of and tries to help the governor of the Bank of England. And I did that at the time when the MPC was first established, which was back in 1997. And I did it as there was an international financial crisis when all the Asian countries defaulted. So that was very interesting. Another highlight of my 25 years at the Bank of England has been dealing with the great financial crisis. The Bank of England is a bank. It provides liquidity to banks. And I worked in the markets area of the Bank of England, the bit that manages our balance sheet, after Lehman defaulted. You might not remember that. It was 10 years ago, so perhaps you weren't so interested. But it really was a seismic event in terms of financial markets and the economy more broadly, and being involved in our response to that event was fabulous. And then the third thing I wanted to highlight was the work that I'm doing currently on Brexit. I'm the supervisor of the international banks, understanding how the economy and the financial system is going to change as a result of our decision to leave the European Union is a big part of my job. So, what does the Bank of England do? The Bank of England is all about money and the financial system, and these 3 numbers speak to some of the things that we do. We are responsible for supervising 1,500 financial firms. We are responsible for 3.6 billion banknotes in circulation, and we make sure that £600 billion worth of transactions settle every single day. We've been around for a jolly long time, coming up for our 325th year anniversary. I was at the Bank of England for the tercentenary, so I'll get there for 325 years. But in fact, even though we were founded in 1694, we're not the oldest central bank. Unfortunately, the Swedish Riksbank beat us to that. What are we there to do? We're there to do today exactly the same as what we were there to do back in 1694. And this old document that you have on the slide is our mission from when we were established way back in 1694, and it's our mission today. And our mission is to promote the good of the people of the United Kingdom by maintaining monetary and financial stability. That's a really easy thing to say. What on earth does it mean? Let me try and talk you through that. It's all about money, and we do four things. We print money, we move money, we make sure the value of money is stable, and we make sure the money that is in the financial system is safe. Let me talk you through each of those. So, as I say, the most obvious connection that many of you will have with the Bank of England is the banknotes that you carry around in your wallets, although probably you just do digital stuff, don't you? Anyway, if you have a banknote, it will have been printed by us. There are 3.6 billion banknotes out there that are together worth £70 billion. Now, given how many people there are in the UK economy, that means, on average, every person has £1,000 in cash. That strikes me as a bit weird and probably tells you something about what banknotes are used for. We've changed how banknotes are made. We've moved to polymer, plastic-based notes rather than paper-based notes. They're cleaner, they're safer, they're stronger, and they last longer. So we've rolled out a new £5 note and a new £10 note, and the new £20 note is to be issued in 2020. And we've just launched a consultation for who should be on the new £50 banknote, which will close in December. I'll come to that a bit later. I should add that the Bank of England is the only banknote issuer in England and Wales. But if you go to Scotland or Northern Ireland, we're not the only issuer. 3 commercial banks in Scotland are allowed to issue banknotes, RBS, Bank of Scotland and Clydesdale. And in Northern Ireland, 4 banks are allowed to issue banknotes. But be reassured, for every Clydesdale Bank £5 note that there is out there in Scotland, there is sat beside it a Bank of England banknote that they bought for us. So it's the same security, the same risk, and the same value as a Bank of England banknote. So that's all about printing money. We also move money, help you buy things. Whether you're buying a chocolate bar with a debit card, or whether you're buying your house with a very large movement of money in the high value payment system, every single one of those movements results in a transfer of money across the Bank of England accounts that are held at the Bank of England. And what our job is to do is to make sure that those electronic payments that you want to make every day are available to you when you need to make them. As I say, every single day we support millions of transactions with a total worth of over £600 billion. The third thing we do, and we'll come back to this later, is we aim to keep the value of money stable, so that the price of the things that you buy grows in a low, stable and predictable way. As you know, when interest rates are higher, people save more and borrow less. When interest rates are lower, loans are cheaper, people borrow more, people save less. That then increases demand. But if there's too much money, too much demand in the economy, prices rise. And while it's okay if prices of some goods rise and prices of some goods fall, if on average we have the prices of all goods rising at a high rate, we call that high inflation. And the government has set, the Bank of England, the Monetary Policy Committee, an inflation target of 2% a year. And our job is to decide the price of money, the interest rate, and the quantity of money to ensure that that inflation target is met. The fourth thing we do is keep your money secure. When you place your money in banks and financial institutions, it's our job to make sure that the institutions you place it with are safe and sound, and that the financial system in general is stable. What does that mean in practice? We make sure that the banks that we supervise have enough cash so that if people want to withdraw their money, they're able to deliver on it. And we ensure that they have enough financial resources to absorb losses if the people they've lent money to, if the economy in general suffers a shock. And most importantly, we ensure that the financial system as a whole can absorb shocks and ensure that consumers, businesses can carry on doing their activity regardless of what has happened to the financial system. What we saw in the great financial crisis was that that didn't happen. Banks were not there to support their customers in the way that they needed. They provided extra shocks to the system. And what we've done is change how we go about doing our jobs to make sure that that doesn't happen again. And I'll come back to that a bit later. So all of those things are designed to support confidence in money. I don't know how many of you have read, but I'm halfway through because it's a very, very big book, Yuval Noah Harari's book, Homo Sapiens, and that book tells in a potted way, but it's still this thick, the history of the human race. And in that book, he describes money as the most universal and most efficient system of mutual trust ever devised. And he explains how having money has really advanced economic growth and the development of our societies. And what we as a central bank do is ensure that that trust in money is maintained so that the economy can continue to grow and society can continue to advance. Let's just do a quick trivial detour about gold. You might not know, but the Bank of England has as much space under the ground as it does above the ground. So if ever you were in the City of London and you see the building, it's a huge building, but there's as much space under the ground as there is over it. There we have 8 vaults, and in those vaults we store 400,000 bars of gold. Every bar of gold is worth about $500,000 given its current price, and so that means that under the bank we've got gold worth well north of 100 billion pounds. Those vaults are pretty impressive to see. Here's a picture of them. Every single one of those gold bars weighs 13 kilograms. So all of the gold in the bank is about 5,000 tons. That's 400 double-decker buses. And it really is so heavy that you can only stack it a little bit at a time. Each one of those rows can only you can only stack 4 bars of gold on top of one another, because otherwise the shelf starts to sag. And what you're looking at there in that picture is gold that's worth over £10 billion So it's, when I went down to the vaults and I was doing the maths, I was like, oh my God, I'm looking at so much money. So it is rather special. And you'll be very pleased to know that no one has ever stolen any gold from the Bank of England, regardless of what Hollywood films would have you believe. Now, the responsibilities that the Bank of England has now are much wider than they were before the financial crisis. And as I say, you're all too young to remember it, but I thought I'd just give you a potted history of what happened in the crisis and what it's meant for what we do. So the great financial crisis started with a run on a medium-sized bank called Northern Rock that happened in autumn of 2007. We really did, in the UK, have people queuing outside of a bank to get money out. The next stage of the financial crisis was when the investment bank in the US, Lehman Brothers, defaulted. It went into administration, and that was a really significant financial institution. And it defaulting sent ripples all around the financial system as a whole, and in the UK led to very significant government bailout. That's what the slide on the chart on the right shows. All of the banks ended up with support of some kind or another, with the exception of HSBC and Barclays. But the amount of support provided by the UK taxpayer was significant. The impact on UK economic growth, you can see in that slide on the bottom. We had growth fall, we had a recession, a pretty severe recession as you can see. And it meant that, that relative to the pre-crisis trend, where growth had been going like this, we lost around about 15 percentage points of GDP, a sixth of GDP lost. That had a very significant effect on the government's finances, as you can see in that chart at the bottom on the right. And in many respects, we're still living with the consequences of that today. So that great financial crisis was a huge shock to the economy, and one that we have sought to address by doing a number of things. Supervision of banks was returned to the Bank of England. It had been done by the Financial Services Authority for a while. We created the Financial Policy Committee to try and ensure that there's a stable financial system, and we tightened regulation of banks. Right, let's do a dive on monetary policy then. Okay. So the MPC is the committee in the bank that's responsible for delivering monetary stability. It meets 8 times a year and is made up of 9 members. The governor, 3 of our deputy governors, our chief economist at the bank, and 4 external members that are appointed by the Chancellor. Every time that committee meets, it reviews the economic data, and in the light of that analysis sets the price and quantity of money to ensure that the 2% inflation target is met. One supporter, and it did this just last week, it also publishes an inflation report that explains why it's come to the judgments that it has. What are the tools that the MPC has? It has 2, as I say, the price and the quantity of money. The interest rates, what we call bank rate, are, as I described before, a pretty obvious way of affecting economic activity. If interest rates are high, people save more, people borrow less, and therefore economic activity is lower than it would otherwise have been. And so with a fall in aggregate demand, so inflation will fall, and so the inflation target can be met. The second tool, quantitative easing, affecting the quantity of money in the economy, is pretty new. We introduced it in 2009 when we hit what we call the zero lower bound, when interest rates were down at or close to zero. QE works in a similar way to interest rates. What we do is we create money by buying assets. So we buy a whole load of gilts and in return give money to the person we bought it from. The price, that affects the yield, the price and the yield of that asset. And so what it means is, rather than just changing the price of short-term money, bank rate, what we can do is influence interest rates all along the yield curve. And so what you find is you can reduce not just short-term interest rates, but also 3-year, 5-year, 10-year, 20-year interest rates, and that feeds through into the economy, generally through spending and investment decisions that people make. The other thing that quantitative easing does by pushing the price of assets up and the interest rate on them down is it makes people feel wealthier. And when people feel wealthier, they spend more. So what quantitative easing is designed to do is, when you're down at interest rates of very low levels as we were, it enables you to continue to provide monetary stimulus to influence aggregate demand in the economy. This slide gives you some handy perspective on where we are now in monetary policy. This chart here on the right shows interest rates all the way back to when the Bank of England was established in 1694. It shows that interest rates of 0.5 and 0.75%, as we have been recently. We're 75 basis points now for the period immediately after the crisis. We were at 0.5, 50 basis points for a long time. You can see they are absolutely unprecedented in history, which is why we were inventing quantitative easing in the crisis, because we've never had to do it before. And what it also highlights that where interest rates are now, where they've been for the last decade, is in a very, very different place to where they have been in the previous 3 centuries. Prior to the financial crisis, if you'd have asked me what bank rate would normally look like, I would have said 5%. And as you can see, kind of we've been well south of that, and don't expect to get back there either. What the chart on the right, the left shows is what we did after the UK's decision to leave the European Union. We were worried that that would create an economic shock, and in order to ensure that demand was maintained, we cut interest rates again from 0.5 to 1/4. And we put more money in the economy. We said there was an extra 60 billion of quantitative easing to buy gilts and an extra 10 billion to buy corporate bonds. So that was our reaction to the decision in June 16 to leave the European Union. These are the latest forecasts for inflation on the right and growth on the left that we published in our inflation report last year. They are conditioned on market interest rates. So the market is pricing in 3 increases in bank rates, so from 75 basis points to 1.5% over the next 3 years. This is the inflation and growth profile that is consistent with that market interest rates. What it shows is that we have inflation coming down from its currently above target level down to around about 2%. So we're doing our job of delivering the government's inflation target. And it shows that growth is expected to be around about 1.75% over that period. And I thought what we might do now is dig a little bit into what's some of the story that underlies that economic assessment. So, what has been happening in the economy? Pay is rising at a faster rate than it has done previously, and with resilient consumer confidence, that will provide support for growth and support consumption and then support growth. Since the crisis, we have had people's wages going up at around about 1 or 2%. The latest figures for pay growth have been 3%, and that is a little bit higher than what we had been forecasting of 2.5%. Now, I don't know how many of you have been following, but we have record levels of employment, record levels of vacancies, and the lowest levels of unemployment since the 1970s. We've had that very tight labour market for a long while, but it hasn't fed through into people's wages until recently. Now we are seeing that happening. So if pay is going to go up, that is going to increase activity and therefore increase demand, and so inflation. So that is an important part of the monetary policy story now, and is good news. The second thing is that the MPC have judged that the economic growth that is expected in future is above the growth in supply of the economy. So we have in our head a speed limit for growth of 1.5%. And if growth is above that, it means demand is growing at a rate that is faster than the economy's productive capacity to supply it. That means that prices will rise if there's no slack in the economy to absorb it. So we are expecting growth, 1.75%, to be above the speed limit of 1.5%, and we start with an economy that has absorbed all of the excess capacity, and so we expect inflation to rise. Investment is subdued. We'll come back to that when we talk about Brexit in a minute. But global growth is continuing to support net trade and so demand. US growth at the moment is very strong. President Trump has put a huge fiscal stimulus in, and that is supporting growth, which affects the whole of the global economy. But global growth is slowing and is becoming more uneven, and that speaks to the issue of trade protectionism, as Mr. Watson asked me to mention. So it is certainly the case that the MPC thinks that global growth is going to fall in future because of developments in trade. As you know, the Trump administration has already brought in one set of protectionist measures against China. China responded, and then another set of measures were brought in August. Now, what does that mean for economic activities? The first is the direct impacts of those tariffs. So, if you're in the US, the cost of imports is going up. There are also disruptions to the supply chain which will affect activity. It's possible that there could be substitutions, so that rather than buying a Chinese import, you buy something else, and so you can manage to avoid the rise in price. And it's possible that the Chinese exporter doesn't export to the US, manages to export to somewhere like the UK instead. But in general, we'd expect there to be, as a result of these tariffs, a negative effect on activity and inflation. And what's important here is it's affecting the US just as much as China, because if the prices of things US people are buying are going up, that's falling real incomes, which obviously reduces activity. There are indirect effects too, though. Business and consumer confidence can fall, reflecting the uncertain outlook. And financial conditions could be tighter too if people think there's if there's greater risk aversion out there, interest rates could be higher. More broadly, a reduction in openness in the global economy will hit productivity because firms can't specialise to the same extent, and it can affect the globe generally, not just US and China, because as US is a major contributor to global growth, it will lower external demand all around the globe. And our current judgment is the trade measures that have been brought in have reduced growth in China by 1%, or are expected to reduce growth in China by 1%, and in the US by a half. Let me go back to the story about monetary policy. With that backdrop of kind of tightening, rising demand above levels of supply, MPC expects there to be a series of gradual and limited interest rate increases that brings inflation back to the 2% target. But there's a big uncertainty out there, isn't there, in Brexit. What happens as we leave the European Union will have a very significant effect, potentially, on the story I've just told. Whether or not we have an orderly or a disorderly transition will affect the future economic outlook. Whether or not we continue to have very close economic ties with Europe will affect that outlook. And more broadly, business and consumer confidence will be affected by how we leave the European Union. It's really hard to say ex ante, in advance, what that is going to be. And so monetary policy is going to have to be very nimble in dealing with that. Let me talk briefly about kind of some of the ways that our decision to leave the European Union can affect the economy. Any reduction in the ease of trade between here and Europe will reduce demand for UK exports. Could be a substantial demand, kind of, it could be substituted, but immediately there will be an impact on UK exports if there is a reduction in the ease of trade. On the positive side though, business investment is likely to recover when they know what the future trading arrangements look like. I mentioned before that business investment has been very subdued, and kind of that's because they don't know what the future world looks like. As the future world becomes clearer, we expect them to invest. And then the hardest thing to call is what households will do. We had expected after the referendum households to be less confident about their future economic prospects because we were going to have a hit to economic growth. Actually, households carried on being very confident, I guess because many of them had just voted to leave, so they didn't see it as a bad thing. All of those things will have a direct impact on growth, demand, and the greater the disruption, the more the negative impact. What's interesting about Brexit, though, is it affects the supply side of the economy too. And it's that balance between the impact on demand and the impact on supply that will matter for monetary policy. Much as we talked about before, a reduction in openness will reduce productivity. When there's operational disruption in the supply chain, queues at Dover, lorries, mismatches in the labour market as production needs to shift from exports to Europe to something else, all of that is going to affect supply. It will be a drag on supply. It could be, if it is an orderly transition, slow, and in which case it might not affect our monetary policy judgments very much, but it could be a very significant jolt to supply if there is a disorderly exit. So we'll have to balance those impacts on supply and demand before coming to a judgment about how monetary policy should respond. Right. Financial stability, let me be very quick on that. As I said, we have 4 things that we do to deliver a safe and sound financial system. We keep the individual firms safe and sound. We take actions to keep the system as a whole safe and sound. Let me give you an example of that. We introduced limits on the amount of money people can borrow in their mortgages, designed to ensure that the total quantity of mortgage debt is not too high. We are there to lend money to banks if for some reason they're temporarily unable to access market financing, and we are there to resolve banks, to deal with them if they fail, so that they can continue to provide banking services to all of you, even though they have got into trouble. Okay, let me briefly touch on climate change, and then hopefully we've got some time for questions. This is a map of temperature change on our planet over the last 100 or so years. And as you know, if we don't change how we let carbon into the atmosphere, those increases are going to continue. It's not the Bank of England's job to deal with the externalities of carbon. It's not for us to make that happen, that is for government. But this rise in temperature can create financial risk. The transition to a low carbon economy can create financial risk. And our job is to make sure that the system is resilient to that. Let me explain a little bit. If the planet gets warmer, if there are more hurricanes, if there is more flooding, there will be greater financial risks to banks and insurers. There were many hurricanes in the Caribbean over the summer last year. They are insured by companies we supervise, so they are exposed to risk because of climate change. Mortgages could be to houses that are on the coast that are affected by rises in sea level. So physical changes in the weather create financial risks. That's what this is all about. The transition to a low carbon economy creates financial risks as well. Many of the world's stocks of oil and gas reserves are unburnable if we are to keep the planet within a low temperature. And so that, stranded assets, creates financial risk too. Banks are exposed to those. What should banks do about that? What should the financial system do? This chart shows some future pathways that we could follow for carbon emissions. What it highlights is two things. One, there will be risks. It's just a question of which risk will materialise. Either the planet will get hotter and the physical risk will materialise, or governments will take action so that the planet doesn't get hotter, in which case transition risks will materialise. So firms need to get ready to manage these risks. It also highlights that if we are to get to the 2-degree world that governments have signed up to, we need to start the transition early. So it is actions today that will determine which of those outcomes in the future we will face. And the other thing to highlight is that by definition these risks are far-reaching. They affect multiple geographies, multiple sectors, multiple different products. And so our view at the Bank of England is that climate change is a financial risk that the financial system needs to prepare for. And all this busy chart highlights is banks make decisions as to who gets finance. How they take those decisions will affect the degree of climate change that we and financial risk that we face. Right, let me briefly go through some things that we're doing at the bank that might be of interest to you. Firstly, we have the bank camera action competition. That's an annual video competition run for the 3rd time this year. 11 to 18-year-olds can enter. The theme this year is what will money be like in the future? Closing date for submissions 10th of December. We jointly with the FT run a Bank of England schools blog competition. That's aimed at A-level students. Again, the theme is what's the future of money? Closing date for that 31st of January. We are having what we've called a virtual future forum. The future forum is where we go out across all of the bank and talk to people about issues. The governors go out. The theme, again, what is the future of money? And if you want to send some, there'll be a series of Q&A webinars going on. If you want to ask Governor Mark Carney some questions, he's on the 27th of November. All the other deputy governors are involved too. Do throw in your thoughts as to who should be the scientist that's on the new £50 note, 14th of December, close for that. And do think about coming to work for us. I know being there for 25 years kind of is quite a long time, and I might be biased, but the reason I've been there is because it's been really interesting. You don't have to have studied economics. About half of the people who join us have studied economics. But if you're interested in the sorts of issues that I've just talked about, it can be a fascinating place to work. All of the material about our early careers is at that place, and that's it. Half of that was comprehensible.
Thank you very much. So really, thank you very much. Really interesting talk about the current state of UK monetary policy. I'm now going to open up the floor to some questions. Does anyone have any questions about that talk? Hands up, please. Ijaz.
Do you think Brexit will be more good than bad to our economy, or more bad than good?
So I think it depends on the horizon over which you are looking, and it depends on what the deal is that we get. And we obviously don't know at this stage what that deal is going to be. I expect there to be some additional friction as a result of in trade between here and the EU, as a result of our leaving the EU. That inevitably will have a bit of short-term pain because we'll have to readjust our economy. But over the long term, who knows? Kind of, you know, sort of. There's a big globe out there. The estimates that we've seen kind of suggest that the hit to the economy, if we end up with a pretty close deal with Europe, are about 2 percentage points. These are not Bank of England estimates. I think they're kind of academic estimates. 2 percentage points if we end up with a close deal over a number of years. 4 percentage points if we end up with sort of a medium connectivity, and then kind of 6% if we end up sort of just like Canada with them. But all of those pale into insignificance compared to the hit that we've had with the financial crisis, right, which was 15 percentage points of GDP. So I think it's worth remembering that it shouldn't be as bad as that. Unless, of course, we have a disorderly Brexit, in which case kind of we might end up causing a financial event. Our analysis, the work we've done, suggests we shouldn't. The banks are well capitalised, the banks have got liquidity needs, the banks shouldn't add to the stresses to the real economy of leaving in a disorderly way. So we've done everything we can to try and make sure we don't have a very disorderly exit.
Thank you very much. Any more questions?
What's the plan to change by money on plastic?
We have to make the banknotes out of something, and we did a very thorough review when we did the move from paper banknotes to polymer. And because they last longer, the environmental impact of using plastic notes rather than paper notes is actually lower.
Any other questions? Nathan?
Many banks are considering leaving the City of London as a Brexit, so what the Bank of England doing to make the conditions more favourable for the banks and other businesses?
So our job is to ensure that the institutions that operate here do so in a safe and sound way. It's not our job to make sure there's activity in the UK. Our job is to make sure that kind of what they do here is right. But of course, we're aware of the broader politics of that. And the UK has always been very open to financial firms coming in. That's why we've got the International Financial Centre that we have. So in my job, because I'm responsible for the international banks, the ones that are affected, I have 210 banks from over 50 countries, and every single non-UK globally system bank, all of them have a bit here in the UK. Now, of course, they have to take their European business and do that in Europe. That is the consequence of us leaving the European Union. There's no longer a passport across the channel that enables them to serve European clients from the UK. But for all of the other business that they do here, there's no incentive for them to move that. And our estimates, so obviously I spend a lot of time on this, as you might expect, our estimates of the number of jobs that are expected to go are pretty low. So our initial estimate was that we might lose 5,000 to 10,000 jobs across all of financial services. Our current estimate is a bit south of the lower bound of that. And financial services employs 1 million people plus. So actually, the number of jobs that the UK will lose is relatively small.
I have a quick question. But you spoke sort of about the zero lower bounds, how interest rates can't really reduce very much further. If the UK was to go into another recession, what potentially due to sort of either Brexit or Trump or anything around that, what sort of policy responses would the Bank of England come up with?
So I think we'd be back to quantitative easing. We've done 3 phases of quantitative easing, 2 in the immediate aftermath of the crisis, and then a 3rd one after the referendum result. And I think we would need to be looking at doing more quantitative easing, because bank rate could come down from 75 basis points back down to 25, so we've got some room for manoeuvre there. But once you are at that lower bound, you're looking to influence the rest of the interest rate curve, and you do that through buying more assets, buying more gilts, buying more corporate bonds to reduce those interest rates.
That's what I'm quite interested if you explain some why is there a zero lower bound? Why can't we reduce the interest rates below 0?
Well, because there's banknotes, right? Everybody will put their money into banknotes. You can't have a negative interest rate on banknotes. If you've got a tenner in your pocket now, in 1 year's time, it's still going to be a tenner. And because of that, there's a constraint on our ability to do that. Now, clearly, you can't do that at the level of the economy. We have £70 billion worth of banknotes and trillion of 150 billion of GDP. So you can't do it. There are limits to which that could be a leakage valve. But in general, we think it's better to keep interest rates positive, so that you don't have the friction with cash and instead move the rest of the yield curve. It's worth saying though, some other countries have got negative interest rates. I'm trying to remember. The Swiss have got negative interest rates. The Europeans have got negative interest rates. I think those are they're the only two that come to my mind. And they've done that because they want to have lower interest rates in wholesale market and accept the friction into retail.
Does anyone else have any questions from anyone? Okay, well thank you very much for coming in. I really enjoyed that talk. I'm sure everyone here did. And thank you very much.